All right, we're going to get started by looking at the S&P 500 like we usually do. All right, you can see that we are in an uptrend in the S&P 500, and we are above all the moving averages, which is very important. One of the most important moving averages for momentum is the 20-day exponential moving average, which is the yellow line right here. You can see that we've been basically levitating above that in the S&P recently. We did have an announcement of a war between Israel and Iran this week, and we'll go over that a little bit later. But that's usually stocks go down whenever there's a war in the Mideast, and gold goes up. We have bonds yield goes down. We have a bunch of things that usually happen, and it's one of the variables that you have to deal with when you're investing. So let's look at the stochastics for the S&P 500 in our chart, our trend lines. You can see that we have two trend lines kind of converging right now. We have an uptrend, which we're making higher highs, higher lows, and we're at the total bottom of that trend right now. And we have a trend line from the beginning of the year, which is lower highs, lower lows. So where that goes, I'm not sure exactly. So it's either going to go down to here and resume this trend here, or it's going to go up here next. We are approaching um, one of the worst months of the year, June. We are in June, right in the middle of it. So don't expect a whole lot out of the stock market during the month of June. July is one of the better months, because we do have earnings come out then. September and August, traditionally the worst months of the year. So keep that in mind as we're overbought right now. We're still overbought, even with the correction we had in the last couple of days. 90 is pretty high. So we've been levitating on this overbought for quite a while in the S&P 500. And a little bit of news that's out of the ordinary and bad, such as the war between Iran and Israel, that could cause the stock market to go down. So let's look at our talking points for today. Okay. Okay, so we are in the middle of June right now. There's not a whole lot going on. We have a holiday coming up, which is, um, well, it's a new holiday, so a lot of people aren't planning around that usually. 20th, we have, let me see, Triple Witching Day. So this coming Thursday, no, this coming Friday, we have a very volatile day in the stock market. We have a lot of options expiring. So if the stock market goes down a couple percent or up a couple percent, you can't take it. You have to take it with a grain of salt, because there's a lot of options expiring, and you have to expect volatility that day. We do have end of quarter window dressing in the last week of June. So that means all the stocks that we're going to have reports of the 13 Fs, which are what the top holdings are for each of the funds and home offices and ETFs. So it's going to be important that the mutual fund managers pad their portfolio with things that look good. And that happens the last week of this month. Okay, July, we have 4th of July, which is one of the most look forward to holidays of the year. So expect a couple good days before and after the 4th of July. Okay, that's the only thing really going on in July. We do have a Fed meeting at the end of July. And let me see what else. Okay, so we don't have a whole lot of earnings happening this month, the rest of this month. And because of that, there's not a whole lot of things to get people excited about. Um, Therefore, that's probably why we don't have a good month of June usually. All right, so let's look at some more of our talking points. S&P is down 0.5% from the beginning of the week. Um, we're kind of not losing, not gaining momentum. We're kind of just hanging in there this week. The Treasury yield is down 2.5%. We had a little, the Treasury, the 10-year Treasury, um, I think it's going down this week because of whenever there is a war and whenever there is uncertainty, people buy more bonds, and that makes the price, the yield of the bond goes down. So it's a flight to safety this week. So what else is happening here? Okay. All right. So let's look at the 10-year Treasury. The normal, what we expect for the 10-year Treasury is as the yields go up, the stock market, the S&P 500 goes down. So we saw that inverse correlation this week. And the reason for that is if there is a higher yield in a guaranteed instrument, such as the US 10-year, then there's less of a demand for stocks which are not certain. Okay, so we can see that the oil went up 9% this week. It went up a good percent yesterday or day before whenever Israel started a war with Iran. Um, the reason why the price of oil goes up is that when there's a fear of a supply shock. So Iran, I think, controls the Strait of Hormuz, and if they do put a blockade and don't allow oil to go through, there's a lack of supply, and that makes prices go up. So it went up 9% this week. That is pretty big. That's not because the global economy is improving and getting better. It's because of a lack of supply, a perceived supply anyway. And that's going to affect inflation a lot. So we have to keep our eye on this price of oil because as the price of oil goes up, inflation, every product that's sold in America, in the world, the price goes up because that's the main input cost for almost everything that's sold in the world. Okay, no change to inflation really. Gold is up 3.5%. Why would gold be up? Well, we had the price of the dollar index down 1%. So our formula is a stronger US dollar tends to drive gold prices lower, but this week a weaker dollar tends to drive gold prices higher. What also helped gold is when there's a war, people gravitate towards safer investments or investments that hold their value. And gold is a safe haven asset. And there was a bigger demand for that this week because of that. All right, let's look at the US dollar chart. You can see it keeps on going down. Um, so it went down another 1% this week. Um, okay, so we'll keep our eye on this dollar. Um, that's becoming a major help for the tech companies. Any multinational that does business overseas is going to see have an assist by the dollar going down. But in general, I don't understand it well enough to comment further than that. Right, the Fear Greed Index. You can see that this week we're still greeding. So greed, or translation, caution takes some profits off the table. don't buy. Okay, so right now we're overbought. We have a potential reason to sell. We have potential war that we might get involved in. That is definitely going to hurt the GDP of the United States. Um, so this, so we'll have to keep watching, see what see what happens there with the war. It might be 2 weeks, it might be longer. Um, the AAII Individual Investor Survey is bullish. So our translation, caution, take some profits off the table or don't buy. So that when the amateurs are bullish, you have to think in a contrary way. When they're bullish, it's time for you to do the opposite and buy or don't sell. Okay. Okay. The VIX last week it was 16. Now it's 20. So we're getting into a possible fear um, in the stock market. We were basically down 1.5% across the board on Friday. So fear is beginning to creep into the market right now. You can see that this is kind of an average. Right around 16 or 17 is an average for the past year. So we're just at the start of maybe going up a little more. So let's see where we are on our emotional chart. You can see we're probably right here. There's been greed for a couple weeks. So um, we had probably on Wednesday, we had this, people were fear of missing out. People were buying the indexes without regard to valuation. And on Friday, we saw a little bit of denial where people were like, oh boy, we're starting a war or we're getting into a war perhaps. So, um, and we had a sell off in the stock market. So we're basically right here in our emotional chart. Here's some important things. Hold on for a second. Okay. Here are some important things that happened this week. We had These are issues that may lead to a crash or a stock market going down. We had tariff, ongoing tariff comments. Um, we had war in the Mideast starting, Iran and Israel starting a war. We had weak dollar, and that's helping to bring up the cost of commodities such as oil. Actually, oil is very underpriced right now, even where it's at now at 70 a barrel, because inflation's been going up for years. And what you can buy with an ounce of gold, how much oil you can buy with an ounce of gold is much, much lower now than it was 10 years ago. So we're going to look into a little bit the oil, but the energy trade, because it's been out of favor for a long time. And we like to be contrarian. And whenever everyone else is not buying the energy sector, we like to start looking into it. Okay, so all right, so let's look at our worst to first. We've been doing this since the beginning of the year. At the beginning of the year, last year we had communication services, IT, consumer discretionary, the best, and financials, the best sectors. This year, look at our best performing sector is industrials. And second, we have communication services is actually second, utilities, and materials. So we did have the worst actually outperforming the best from last year. Let's see what else we have here. Okay, healthcare is continuing to be a laggard. It's been underperforming for 3 straight years. So whenever a sector like this is outperforming 3 straight years, that's when I start looking at individual stocks in that sector. Same thing with the energy. Energy's been underperforming for the last 3 years. Look at this. Negative 4.6, it's 1% 2024, 1% 2025. And so far this year, it's only up 2%. So it's a good time to start looking at energy stocks. What else do we have here? Okay. Okay, let's look at some of the top performing stocks or market movers. Okay, we have Oracle up 7.6%. They were actually up 14% on Thursday. So they're on a roll. Um, I thought it'd be interesting to look at Oracle just to see what their numbers are. Um, their PEG ratio, according to Yahoo Finance, is 2.25. They've always been expensive. So they're 2 times overvalued. So the forward PE is 31. So that implies Yahoo thinks that they're growing at 15%. Let's look at their numbers. So you can see from Oracle's numbers that they're actually, if you divide these year over year, they're growing 14% from 25 to 26, then 20% from 26 to 27, and 20% from 27 to 28. So they're growing 20% for a big company like that. That's pretty good. 20% with a PE of 31, that is probably a PEG ratio of 1.5. So they're 1.5 times overvalued. All right, let's look at some more of the top stocks going up and down. Okay, we have MasterCard, Visa, PayPal. These are stocks that are affected by a news story we'll go over later on. Um, there's a news story that Walmart, big retail, is looking into stable coins as a method of payment. one of um, one of Walmart's biggest complaints is paying that percent to Walmart, to MasterCard and Visa. And they don't like doing that. And they're trying to find alternatives. All right. Um, so that's why all the payment processes are down. Look, MasterCard's down. MasterCard, Visa are down 5%, PayPal 5%. So we're going to go look at those later on today because it's one of my biggest holdings, MasterCard and Visa. All right. So let's look at more of our talking points here. Oh, forgot the sectors. Okay, sector ETFs. Um, let's look at the 10-year. We always like to look at the 10-year and compare it against the sectors going up and down. So our cheat sheet, yields, let's see if the yields are going up. They're actually going down recently. They're going down. So, but they went up a little bit on Friday. Let's look at if the yields are going up, we expect that's good for large cap tech stocks, financial sector. Well, what's happening on Friday? Okay, so let's see if that's what's happening in our sector ETFs. Okay, so if the yields are going up, that's bad for home construction because that makes homes less affordable because you have to pay a higher mortgage rate and you sell less houses. And same thing with, let's look at home builders, same issue. Um, Well, we have a bigger problem is the war is affecting the stocks, the war between Israel and Iran. So that's kind of, this might not be totally working because we have a bigger issue that's affecting the price of stocks. So in the context of a war starting, let's see the stocks doing that would do the best, oil, because if there's a possible fear of supply issues, then the price of oil goes up if there's a supply problem. Energy, same thing. Energy, if the price of oil goes up, then the energy sector will do better. Gold miners. Okay, so let's look at our cheat sheet for a okay, a war in the Mideast playbook. If there's a war in the Mideast, the what usually happens is there's a flight to safety. So gold goes up. Gold is kind of a safety trade. Treasury yields go down because more people want to buy things that are going to pay a consistent yield and are safe. So the more demand there is for treasuries, the yield goes down. Stocks go down in when there's a war in the Mideast. We have defense stocks go up because there's a higher demand for missiles if America starts going into the war also, or if Israel buys more from our companies. Oil prices go up because there's perceived lack of supply if there are issues in the Mideast. So that'll help energy stocks go up. So high yield stocks will benefit because as the US Treasury price goes down, the investors will gravitate towards safe investments. And usually safe investments are ones paying dividends. And if you have treasuries yielding less, then investors want a higher yield and they would buy dividend stocks. So we're going to skip from our normal playbook for interest rates going up and down. Now we're in like a war scenario. So all these would affect the sectors. So let's see if that plays out. Yes, gold stocks are going up because gold is a safe investment. So there's a higher demand for gold. And metals and mining, that could be that could be going up because of gold. If the dollar is going down, that would help all commodity prices. Healthcare sector is one of the safest sectors in the market. It pays a dividend, and utilities pays a dividend. So this is kind of making sense. Biotech, um, industrials. Perhaps in a wartime environment, industrial sector will benefit. So, okay, that was good exercise. Let's look at some more of our talking points here. Okay, where did I leave off? Okay, let's look at Dan Now's picks from the beginning of the year. ADTN minus 9%, not so great. Cisco, this is best pick so far. It's up 8%. IJJ, the mid cap ETF, down 3.5%. KBWB, almost flat for the year. This is the big bank ETF. Cash is yielding 4%. So it's actually probably one of the best investments he has this year. All right. Um, here are some charts that I thought were interesting. Okay, here are some charts that I pulled out that I thought were interesting. We have gold. Look at this. This is one of the best performing investments this year. It's up like 27%. You can see that it's overbought right now, and it's right in the middle of its trading range, its trend lines. So um, gold is benefiting from a high demand from central banks. There, there's a gradual move away from the US dollar and US dollar investments. And central banks are buying gold a lot for that reason. And there's a demand for safe investment in troubled times like we have right now. And the price also, the um, the US dollar is going down. So gold is one way to gold basically holds its value over time. So that could help in that scenario also. Let's look at XLE. This is a sector that's been going in a downward trend for multiple years. But look, we're right on the edge of breaking out of that trend, and we're starting a new trend upwards. So I think this could be a time when um, I think I'm going to start dollar costing into some high yielding um, energy stocks. There's a lot of stocks in this industry that pay a good dividend, and that's going to be high in demand. Um, and this has been out of favor for what, how many years now? So I'm going to start looking into stocks in this energy world. Okay, look at this uranium. We've been following this for quite a while, but it's up what 30% since April. Um, there's a new story that Trump is helping start some nuclear projects, and that really gave this ETF a real big help. Okay, so okay, here's a stock that's in one of our tech leaders in our mutual funds. Oracle was 2.45% of JP Morgan US tech leaders. This week, they came out with earnings and the shares of Oracle went up 24%. It's the best performance since 2020, 2001. And they said they have momentum in their cloud business. And Larry Ellison said the demand is insatiable. There's a lot of demand for what they're offering. And so it went 14% Thursday, 7% Friday. Um, we saw that they're overvalued. They're like their peg ratio is over 2. So that means they're trading at a premium, but they're growing 20%. So not too many stocks are growing 20% consistently. All right. Okay, I thought there's a YouTube presentation I saw. Billionaire Bill Ackman's key to long-term investment success. Here's some Bill Ackman likes to model what he does based on Warren Buffett. He's a big Warren Buffett fan. I actually met him last year in Omaha when I was at the Berkshire Hathaway convention. So he basically has some rules he follows. Um, he likes to buy and hold super durable companies. He likes the idea of royalties, where companies earn forever royalty fees. For instance, Universal Music, um, they get a royalty for every song that's played. And Hilton, they actually own a brand. So much like McDonald's, Hilton has franchises that use its brand. So other companies put up capital to use their brand. That's an example of royalty. Uber, they don't actually pay for the cars. They don't do the driving. They have a platform and they aggregate demand. So he likes stocks that are not easy to replicate. And what matters most is the present value of the business in relation to future cash flows. And when approaching a problem in life, this is something he was saying in his talk, he likes to make small progress every day. So if you make 0.1% of progress, it compounds and eventually you'll fix your problems and get your projects done. So if you're investing, dollar costing regularly until you're fully invested is his style. Um, and I found another place on the internet that went into, what he likes to see in businesses. One is simple and predictable business, free cash flow generation. These are all what Warren Buffett looks for also, I think. Dominant market position, large barriers to entry, high capital, high returns on capital, limited exposure to extrinsic risks, strong balance sheets, excellent management or governance, contrarian investing, long-term investing, and active engagement. So Bill Ackman's known for like a helping company, like taking large positions of companies and helping them change so that they're more efficient and more profitable. Here are some of his top holdings. Uber, Brookfield Corporation, which is an energy company, QSR, Restaurant Brands, Howard Hughes, Chipotle, Canadian Pacific Railroad, Alphabet, Hilton, Seaport Entertainment Group, and Hertz. Okay, so we can see that Uber, we already talked about Uber being a platform. They're like a brand aggregator. They don't necessarily own the cars or drive them. They own a platform and they take 20% cut of every transaction. So QSR is similar. They they own a brand and they're franchisees that use their brand and pay them a royalty for every sale that's made. I think they own D.R. Horton, and a couple other restaurants. Um, Canadian Pacific, they are a railroad. They are monopoly, so large barriers to entry. They don't make railroads anymore, and they'll never make railroads again. So by they're a monopoly. So that's an example of large barriers to entry. Google, they have a 90% share in search. It's being challenged right now by AI. So their large barriers to entry is kind of being chipped away at. So it's going to be very interesting to see next year or the next if Google continues to be in its top holdings. Okay, that was a good little exercise. Um, Here's a story. Visa and MasterCard shares slide on stablecoin fears, but is it sell-off too harsh? So the story is Walmart and other retailers are exploring stablecoin ventures. Um, in other words, will Walmart take stablecoin instead of credit cards in the future? We don't know. And because there was this story, the stocks, Visa, MasterCard, American Express, PayPal, sold off 5%. Here's what I think. Um, they currently, Visa, MasterCard, American Express, they are they consist of 90% of transactions through through credit cards. Actually, over 60% of transactions around the world are still cash. So um, so they have a big percentage of consumer usage. Now, users like the idea of having credit cards where you get 1% back, where there are perks and protections. and they basically borrow money for free when you're using a credit card. In stable coins, you have to fund stable coins with money before you can use it. It's like a debit card. So how many people are going to want to or not? How many people are going to want to prepay for a debit card to use? No, I don't know. I don't think so. I like the idea of borrowing money for free for 30 days and pay it off. And that's what's working right now. I think it'll be decades before users switch from credit cards, or years or decades. Um, just think of how many people are in cryptocurrencies right now. Maybe 2%, 1% of people. And how many people are using that for transactions right now? Less than 1%. Um, it's going to take a long time for people to switch from using credit cards. Um, Visa and MasterCard are actually pretty high tech. They're actually already exploring the use of crypto on their platform. So we'll see how, as invest in stocks, you got to constantly watch to see if they're losing some of their moat or losing some of their. Let's see what these things are. So let's look at Visa and MasterCard in terms of Bill Ackman's principles. Simple and predictable, yes, absolutely. They take a toll of every transaction on their network, and the number of transaction grows every year because people switch from cash-based transactions to credit card over time. Free cash flow, absolutely. Both of them have super free cash flow generating companies. They're both dominant market positions. Uh, Combined, American Express, Visa, MasterCard are almost over 90% of transactions. Um, Large barriers to entry. I'd say having it over 90%, when you have people that have used these cards their whole life, it's going to be really hard to get a stable coin, people to use stable coin at Walmart. High returns on capital. We're going to review, let's look at that right now. MasterCard, return on equity, 187%. That's the highest of any stock that I follow. That's pretty good. Let's look at Visas. Oh, I didn't put it down. It's pretty high too. Okay, so let's look at some other things here. Large barriers. Okay, we have limited exposure to intrinsic risks. Okay, so for Visa and MasterCard, if there is a recession, people still spend the same amount of money basically. Um, do they? They would, I guess they would spend less in a recession, or if there's some kind of problem like COVID, you would spend less on in general. So that's like an intrinsic risk, but that's pretty limited if that something like that happens. Um, Strong balance sheets, absolutely. All these credit card companies have strong balance sheets. Excellent management, yes. Contrary investing, okay, doesn't apply for these. Um, Long-term investing, mm, I think Warren Buffett likes banks whenever he buys and holds stocks. A good portion of Warren Buffett's holdings are financial. So you can probably buy and hold these stocks for a long time because in 10 years, there's still going to be demand for credit cards. All right. So I guess that passed Bill Ackman's test, Visa and MasterCard. Let's look at MasterCard's numbers. They're growing around 17% from this year to next year and the next year after that. Their PE ratio is 33. So they're 2 times overvalued. They also pay a 0.5% dividend. So that's amazing for a company this size to continue to grow at 17%. And look at this chart. The chart is just amazing. it's one of the only consistently uptrending stock. I mean, charts that we have. Um, if there is a problem with inflation, people spend more money and buy less, spend more money for a product and they buy less of it, and it averages out so they don't actually lose in an inflationary environment. So the volume stays consistent. Let's look at their statistics. Their PEG ratio is 2.5. That matches our numbers. Um, Profit margin, 45%. That is amazing. That's 3 times more than we want. Return on equity is 187%. That's 10 times better than we want. And they have 8 billion in debt out of 10 billion. So that's not a whole lot at all. That's pocket change. Okay, so that's really good numbers for MasterCard. Let's look at what CFRA says. They said, no, Morningstar says they're 10% overvalued. And CFRA says a buy with a 690 price target. CFRA says they're overvalued by 7%. So that matches what Morningstar said. The great thing about this stock, look at this. Their free cash flow is going up at least 10 to 15% a year for 10 years. Same thing with revenue. It's going up in a straight line. Those are great numbers for a growth company. This is probably the best part of their numbers. Their return on equity is 190, and that's been going up from 60 10 years ago. So every year it goes up an amazing 20 points. So they're getting more efficient as they go on. Let's look at Visa. Visa, it seems like they're growing around 12% from this year to next year. And their their PE ratio is 27. So if you divide 27 by 12, you'll get 2.2 times overvalued. Their stock is similar to MasterCard, where they're in an uptrend. They're one of the only uptrend stocks we're following this year. And you can see they're well within their trend line. It went down 5% Friday. Morningstar says they're 10% overvalued. And CFRA has a buy for the stock. And what they said about Visa is their exceptional execution, strong competitive position. Visa commands a moat enhanced by network effects. And network costs rose 17% since 2019, while revenue grew over 50%. Okay, they're talking about this VAS. I don't know what VAS is. VAS presents substantial opportunities. Okay, we'll skip that. Okay, let's look at their numbers. Fair value. They're overvalued by 4%. So they're trading at a premium. You can see they also have numbers going in a straight line, up like 10% a year. And you can see the revenue also is up 10% a year, 8%. But that's still what you want to look for in a growth stock that you buy and hold. These seem like they would be Bill Ackman like stocks. Okay, this is the big news for this week. There's Israel hit Iran's nuclear program, and there's firing back and forth between them now. So a war in the Mideast, what usually happens, flight to safety, gold is up, treasury yields down, stocks down, defense stocks up, oil prices up. We just started to see oil prices go up. Oil has been out. Oil has been out of favor for multiple years, and this could be like a trigger for energy to perk up again. Okay. Okay, let's look at, okay. Okay, so let's look at our stock screen for this week. What I did was I was keeping in mind this, what happens in a war, and I picked out some interesting stocks to look at. Flight to safety, gold is up, treasury yields down, defense stocks up, oil prices up. And these are stocks that could benefit from that. We have Imperial Oil. These are stocks that are um, we've been watching every week, but we've kind of been ignoring because we had other themes until now. Eli Lilly, they are a world leader in weight loss drugs. They are growing 30% a year. And in a wartime, people are still going to need drugs and they pay a dividend. ExxonMobil, they, they're an integrated oil company and they pay a dividend. And as the price of oil goes up, they're going to benefit. Merck is a drug stock that recently had a Keytruda, their drug, approved for another use. So that has a little momentum, and it's a defensive stock because it's out of favor sector, and it's everyone needs to buy. It's considered in drug stocks are a defensive sector. Here's ConocoPhillips. They're a oil stock. EPD, Energy Products Partners. They are also oil related. Energy Transfer Partners. You can see it's a PEG ratio around 1, so they're fairly valued. Report McMoran, they mine for gold and copper. So as the US dollar goes down, as people buy gold for flight to safety, their value is going to go up. You can see they're 25% undervalued right now. Imperial Oil is another oil company. Baker Hughes, we've been talking about it for a while as they're a drilling company. So as more people as the price of oil goes up, there'll be more drilling in America. What other stocks could help it? Devon Energy, another oil stock. Uh, Coterra Energy, they seem like pretty undervalued, 0.4 PE, PEG ratio. Edison International, they're a stock that pays a dividend and they make energy. So they would also be helped by a AI infrastructure. And Kinross Gold. Okay, this is how I kind of think whenever you have sectors that are out of favor and there's a catalyst for them to be in favor, you start looking at those kind of stocks um, as potential stocks to invest in. I like the dollar cost. I like to put a small amount in stocks as starter positions, and if they go down, I usually buy a little more. Okay, that is okay. Let's look at our. This is from the beginning of the year. Sectors of the stock market in a Trump presidency. Okay, so we had a theme at the beginning here of deregulation. Um, what what sectors could do better in a Trump presidency? So we had a theme of deregulation. We had possibility of lower interest rates, and we had, see, okay, those are our two themes. So now we have utilities benefiting from that deregulation, and we have utilities benefiting from AI infrastructure demand. Um, we have the energy sector. Deregulation will produce more oil, and we have industrials will benefit because that'll help industry build. And well, industrial sector has helped because if you're making factories and then you don't have to follow as many regulations whenever you're making factories. So it seems like industrials is actually the best performing sector this year. So we even started process of deregulation yet. So that is that is a good check on some of the things we thought about at the beginning of the year. All right, that's all I had to say for today. Hope you enjoyed that, and I'll see you next time.